following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and welcome back to the Option Block, your bi-weekly source for options wit and wisdom. My name is Mark Longo from theoptionsinsider.com, as well as the ever-expanding Options Insider Radio Network. And I am joined today on the Option Block All-Star panel by the usual suspects, starting off with the man making a return appearance on the program. He's been away for a bit, but now he's back. I'd imagine because there's a federal holiday coming up on the end of the week. He is none other than Federal Holiday Mike, a.k.a. Monday Mike, a.k.a. Mike Kavanaugh of Know Your Options Inc. /SCG fame. Monday Mike, welcome back to the show, sir.
It is great to be back. And I was actually going to make a request that we do the taping on Friday because the market's closed and I wouldn't be here. And it would keep my streak of the federal holidays going.
It would be in keeping with your record to date, sir. We definitely should have considered that, but too late now. We're stuck recording on an actual trading day. So.
But I'm here and I'm overly excited. That music gets me going every time.
Gotta love that rockin' tune, which I believe we owe the credit for to one John Grigas of Options Express fame, who also joins us on the old All-Star panel today. Mr. Grigas, welcome back from the wilds of bachelor parties and, of course, Canada.
Thank you. Yeah, that music does get you going, especially on Mondays when you're trying to work off a hangover from Saturday night for Big Tim Navabi's pseudo bachelor party that we just tossed together for, late last week. But I'm here. I'm ready to go. Market's up. Apple's up $18.50. So it is a weekday if Apple's up.
Yeah, it's Monday. Buy Apple, right? Of course.
They pegged that stock on Friday at expiration, down to 600 within a few 20 or 30 cents, and then off to the races today. It's amazing.
Funny how that works. The ability of the market to peg, or pin, I should say, is it still impresses me to this day, all these years later. And of course, listeners, if you have any questions about Canadian regulation or indeed the Mounties, John Grigas is the man to talk to.
Yeah. Hunting season, fishing limits, and what equities trade on the TSX. You just give me a ring. I'm more than happy to talk it through.
That I've always said Canadian regulation was your bailiwick, and now we have official proof, as you are officially licensed in the Great White North. And then speaking,
and you need a 60% or more to pass. So that's funny.
And you knocked it out of the park. A D is passing in Canada. We know what their education system is up there. And I start the show off offending all of our neighbors to the Great White North. And speaking of the Great White North, we are joined last but certainly not least by the man from the Great White Northeast, none other than Maine, and Andrew Giovinazzi of Lobster Bib fame, a.k.a. OptionPit.com. Mr. Giovinazzi, welcome back to the show. Short deltas or no?
Yes, thank you. Short deltas or no, and these rallies are getting, just more rally-like. I just feel like these are Apple rallies. No other stocks matter but Apple.
Yeah, we were talking about this on one of our shows earlier this morning, actually, with your compatriot there, one Mark Sebastian, and we were discussing just what was underpinning the rally in Apple today. Just a Monday, up 3%. That's just typical Apple behavior, it seems like, these days. It's amazing.
It's like, I guess we'll get it to the vol talk, but, what do we get going here when we get over 1450 and actually some people think the market's going to go up? I mean, I'm still waiting for the volatility products to break again. Well, I mean, we'll get to that part, but it's very, very, very strange how I don't know. It's almost like the air rally, and I'm as bullish as the next guy in general, but these rallies feel very air-like.
Are you saying
as soon as Apple rolls out the next product and calls it Tulip, we will know that is the time the market comes down.
Well, we can officially, I think, start referring to the NASDAQ as Apple Plus, because that's pretty much all that's going on out there in that index.
I mean, really, you have to think of like, that's it, right? But we're still, we're not at tulip valuations really on anything. And I think that's part of the reason why, we rally, right? Because the market really isn't at an insane valuation. It was just crushed in the toilet for so long. And now it's starting to come up to a valuation, and everybody's like, okay, do I still want to hold equities? But I guess I could buy treasury bonds and make no money too with the same risk.
It's all scintillating stuff, and I think it's time we dove into it in the aforementioned trading block.
The trading block.
All right, and welcome to the Trading Block. This is, of course, the portion of the show where we discuss what's going on, what's moving the markets in today's session. And as Mr. Andrew alluded to at the top of the show, it was a wee bit of an up day. Most of the major indices up about 0.5% or more on the day. The S&P up about 0.7%, actually, or 10 handles, to 1418. The Dow up about 52 points to 13,264. The good old NASDAQ, aka Apple Plus, up nearly 1% almost on the day, or 28 handles to 31.19. And the good old VIX cash also ticking to the upside, closing at 15.64, up about 0.14 or nearly 1% on the day as well. So lots of upside, lots of green. And Andrew, we were discussing in the intro to the show the vacillating nature of volatility in these days, particularly in Apple and just in general too, how, we're seeing these, we saw last week, we saw this massive sell-off, and yet vol performed very strangely going into and out of that sell-off. And it's been a kind of an interesting and strange week to watch vol as well. So what have you been watching? What has caught your eye over the past, over today's session? And then we'll kind of go from there.
Right. Well, I think the VIX move is like sort of normal with, we had the nice rally in the index, and the VIX coming off the weekend up only 14 cents. So we would have expected a lot of, quite a bit more. So, the fact that SPX rallies, that will take out some of the weekend effects. So for VIX, okay. What I found again interesting, and what I continue to find interesting, is the way that the other volatility products, the ETFs and ETNs and ETPs, just get smacked around like, little puppies. The VXX got marked up again on the close. I'm just watching fairly volatile intraday trading for these things. And I believe that they're still driven by these other more levered volatility products that are starting to, they just jack this stuff around all the time. And I'm kind of at one of those, I have positions in them, and we are busily, starting to slowly trim them down, basically.
We have this slew of academics coming onto our other program, the Volatility Views program, discussing all sorts of aspects of volatility research and analysis and tail risk and how skew impacts this and how different moments of volatility. And today we were talking about the dynamic or vol that's going on out there and how different skew in the indexes is impacting some of the other individual products. But no one yet really seems to have bitten off any sort of study or embarked upon any sort of study or strategy or analysis of something we talked about on this show a number of times, how this growing universe of the ETPs around VIX, how that's starting to drive the actual underlying as opposed to what's going on out in the SPX. And I think that would be an interesting study into and of itself to start really tracing back where some of this movement is coming from. And of course, you have an underlying that's trading in and of itself. So you have the VIX option paper flow, VIX futures paper flow, how that's impacting it, as well as the underlying in the S&P volatility, as well as this massive and growing universe of products. And if some academic could, it's a bear of a thing to bite off, but if some academic could sit down and really analyze and try to estimate which percentage is contributed from where, I think that would be a very interesting study to see done.
Yeah, I don't think it would be that difficult of a study to put together. All of the prospectuses of these ETNs and ETFs that are trading the volatility list what the algorithm is and what they're actually held to create a share. I think the VXX is for every 250 shares, and there's a $4,000 minimum of investment. For every 250 shares, they have to purchase one front month contract of the VIX. And the Thursday before the Tuesday the VIX expires, they have to begin rolling each one of the front month contracts into the back month. So, there's really not that hard of a concept to understand. If the VIX market makers know how many shares exist in the VXX, they're going to short the front month because they know that whoever manages that VXX is going to have to sell the front month in a 4-day period, and they're going to get long the back month, and the fund is going to come in and buy the back month. Yeah, they do. And if anybody wants to see how this is going to play out, just do a Google search on the front to back month wheat spread in 2006. It was the fall of 2006. Same thing. Goldman was, I think it was Goldman, but love him or hate him, they probably had something to do with it. The GSCI commodity index was loading up on corn, wheat, soybeans, everything. In the wheat spread went 180 cents in like 8 seconds and came all the way back to full carry. And it did a lot of damage in the meantime because the market makers were short in the front month, buying the back month, and a lot of people lost a lot of money. So I would say this is probably going to unfold very similarly, that there's probably a good chunk of people making a bunch of money on this, and it's going to go upside down at some point, and it's going to completely blow the top off of it, and it's going to come back in like it never happened. But there's definitely some disconnect going on. I don't think it would be that difficult to figure out, but it would take a lot of time.
Yeah, I'm with Andrew. I have to imagine the market makers are already fading those rolls pretty aggressively. There's a pretty relatively straightforward, how these funds unwind and roll and execute their rolls on a regular basis. So I'd imagine that's already being faded pretty aggressively. But like we mentioned a couple of weeks ago when I was down at that risk management conference, there was a big topic of discussion about what is driving the contango and the VIX futures, and whether it's these levered ETPs in the VIX world, and they're the ones who have to be the net buyers of long-term vol to offset their short-term positions, or whether it's annuities and things like that. And so there's a lot of players lurking in the ether in and around this space, and how they all tend to bump into each other is very interesting to watch. But at the end of the day, I think you can safely say that VIX has many other masters at this point, aside from straight up S&P 500 front month skew and volatility.
Yeah, I think that's the real takeaway. I mean, it is now there are other factors, and that's just the way it is. And I think intraday it trades differently than it used to trade. But I will say, just to earlier John saying, I mean, the contango and those type of numbers are down substantially from like 2 weeks ago. I mean, we were looking at May cash around $7, and now it's $3.50, and April May is down to $1.90. I mean, they're all probably reasonable numbers. I wouldn't think they're not necessarily shortable, but we still get the SPX climbing, and the VIX is not hitting like 14 handle or anything like that. So somebody out there somewhere is still on the bid for these puts because they're gonna, they need them for something. So nobody's letting them go yet. That's my.
You need those units at the end of the day. Someone needs units somewhere.
I would like to see people sell them before I really get excited about us going high. But
Andrew, you're so old school in your fundamental indicators.
I like to see people doing certain things.
People have to do stuff before you get excited. We know that. That's your history on this show, Stir. You get excited when people do stuff. Well,
exactly.
Speaking of doing stuff, the folks over at NASDAQ certainly are doing stuff. And I'll be very interested to get your opinion on this, John, because I think this directly impacts you first and foremost here. But the folks over at NASDAQ, after having been so successful with NASDAQ OMX, which is one of their options exchanges, as well as the Philly, which is their other options exchange, announced very late last week, that they are considering, or I guess beyond the considering point at this stage, they're actually about to launch a new options platform in 2012 that they say will complement their hybrid floor-based NASDAQ OMX and the fully electronic NASDAQ options market. So there's just a lot of interesting things to parse there from an options perspective. One of the things we've discussed on the show a number of times, particularly for the audience for this program, which is the very active, very sophisticated high-end spectrum of the retail audience, how they're constantly complaining that fragmentation is starting to eat into their trades, how if you're doing any sort of multi-leg spread, you're constantly getting hung up in one spread book on one exchange or another one, and it's becoming more and more of an issue, even to the 10-up guys now who are starting to try to get spreads off that they're having a difficult time getting filled. And yet one more exchange now diving into the fray, and apparently from all of the preliminary information, it's going to be targeted directly at retail, trying to offer rebates to retail. So in a sense, they're offering rebates to the retail brokers in order to attract that business. So an interesting development. And Mr. Grigas, as someone who spends his day in and of that retail world, what's your take on yet another NASDAQ exchange jumping into the fray?
Well, I think you nailed it. I mean, the more there's an article out there by our education department this week from Nina, with saying that sophisticated trading, i.e., spreads, butterflies, and condors, have become more popular, and they're occurring more on our platform and in the industry. And the more exchanges you get, I mean, the more difficult it becomes to fill these orders. I mean, only certain exchanges accept certain types of spreads. We try to put them out there, but the more exchanges you have and the more quotes, the more NBBOs won't line up on one exchange. And for the retail client to understand that what they see in there, they can't get filled at that price because it may be built off of two different exchanges is a tough conversation to have. If you see a price out there and you're trying to sell it at that price and you can't get filled, what is this, the 11th or 12th exchange that we're going to have now?
Yes.
I mean, it does make it difficult. We have a whole execution desk that just sits there and just almost tries to leg spreads all day, on one exchange versus the other, that the customer is not even aware of. So, I mean, customers are trading more complex spreads and more exchanges. It's only going to make the situation more difficult.
That's going to be my question to you too, is what percentage of your day already right now is spent dealing with calls that are that exact question? Hey, I'm hitting this spread on the bid, it's bid away, why am I not filled? And having to walk them through that, well, you're on one exchange versus the other one and it's not matching and all. I mean, I'd imagine that's a significant portion of your calls these days.
Yeah, we get a few dozen of those, and usually they go pretty smoothly, but it's the caller that says, I don't care. Before you even get the second sentence out, they're just cutting you off because they don't care what the reason is. Okay, he's trying to sell it at that price, or he or she's trying to buy it at that offer, and they cannot get it filled. They don't want to know the technical basis or why. They just want it done. So don't enjoy those calls whatsoever. And sometimes the size isn't there too. Well, people trade in 20, 30 lots, and they have a one lot, that's kicking out the price, and we won't like those then, because then the customer will call back and say, hey, I don't want a one lot, I want 30. So you try to do right by the customer, but sometimes it's impossible.
They had an interesting quote in that article in the journal that first kind of ran with this story from one of your competitors there, and I know the guy. He's actually a good guy, a nice guy. I like him. He knows the business pretty well. But his comment was essentially, "Oh, the more exchanges, the merrier," from a retail perspective. And at this point, I probably couldn't disagree with that statement more. Just given all of the feedback we receive, and from what I'm sure you guys receive on a daily basis, far more than we do, from that retail segment, is that they're fed up with this fragmentation. They're fed up with all these exchanges coming in and trying to carve up the existing market share out there without really bringing anything new to the table. And perhaps I'm being unfairly dismissive of this exchange. Maybe you've heard more information than I have, John, because this is very much in your wheelhouse about what exactly the structure of those rebates is going to be and how it's going to somehow enhance retail. But I've heard this story before, and I've never really seen an exchange come out that really has done right by the retail audience. They've all been looking to go after other segments of the options audience, and retail is usually far and away the last consideration for them. So I'd be curious to see. I mean, it's interesting.
Yeah, I mean,
go ahead.
I mean, anything outside of saying that it's not payment for order flow is just window dressing. I mean, that's why they're people go into businesses or do more exchanges to make money. So I mean, that's why they're doing it. Now, we tested for execution and liquidity before we would route to one of these exchanges, and I guess in one aspect, from a retail standpoint, it is better for the retail client if they can provide a better marketplace. But I think with the ones we have now, they're just duplicating that and fighting for order flow.
So you haven't heard any more about what these rebates are going to be or what's going to make them stand out from what's going on in the marketplace right now? Nothing like that?
Nothing yet, no.
So it's all pretty much just smoke and mirrors at this point. No, it's funny. This time last year, at the Options Industry Conference back in May last year, the big story was that the Miami exchange is going to be the 10th exchange. That apparently has vanished into the ether, and now all of a sudden NASDAQ's opening a new exchange. ISE is considering
there a startup on that Miami exchange.
Yeah, it's still around, but it's having all sorts of issues and management issues, which is never a good sign before you've even launched the exchange. And then there's of course, the ISE's rumored floor that they're going to be coming out with. It's a very, very strange, somewhat backward time in the options world these days. But this one I thought was
going to be a closet with one market maker, right?
Yeah, exactly.
It almost feels like the auto industry, where they're going forward yet going backwards at the same time. I mean, it's very, very exciting.
It does sound crazy, but I've seen hints, from our institutional desk, the hint of a portfolio manager or trader that's using options not to speculate but to hedge risk within their portfolio, where they don't want to put it into the buzzsaw that is a high frequency algo, infested electronic market. They're more comfortable with a hybrid between human interaction that understands how to enter the order into the marketplace. So I think it's crazy from the surface that these guys are fighting over who's going to be able to go backwards with a hybrid where there's a floor and there's market makers that are, integrating technology into the marketplace. But I think it's coming from the demand of not the retail world, but the demand of the institution saying, hey, look, I'm not here to make money on this stuff. I'm here to hedge risk using these options. And you guys are opening up more risk with these high freak algo electronic exchanges. It scares the crap out of us. I'd rather have somebody who knows how to enter this order so I can get one price and feel comfortable knowing that my order is not going to get sent into the wood chipper. And I think these institutions, these exchanges, are trying to figure out a way to provide that, because a lot of the liquidity is going off the floor.
It's just being matched.
It's being matched and reported to the exchange. I mean, we've seen a boom on the institutional side, people calling us and saying, I'm not putting a 26-year-old junior trader in charge of a 10,000 contract put butterfly. I'm not going to let that happen. You guys work the order. And the fundamental need of hedging risk is there. It's always going to exist. If there's 99 guys out there that are snake oil salesmen that are using derivatives to make money, which is the wrong message. It's an instrument that's created to hedge the money that you own. If 99 out of 100 are using derivatives in the wrong way, they won't be using them wrong for a very long time. They'll be gone. And the guys that are using the derivatives and the options in the right capacity, they're not going anywhere. And they're saying, look, that's a buzzsaw, and I'm not putting my order in that buzzsaw. So somebody better figure out a way to make the technology with the human interaction work. I don't think offering rebates to the retail world is the best way to go, because at the end of the day, who's it going to benefit? It's going to benefit the brokers. And haven't we seen enough of that in the last however many hundreds of years that the retail guys are going to be call it a buzzsaw or a wood chipper. They're going to be putting it into the buzzsaw and the wood chipper, and they're never even going to see the positive. They're not going to be rewarded for taking the risk that they're taking. And until somebody figures out the right movement on how to educate the retail person to benefit from the orders that they're putting in, whoever does that, I think, is the one that wins. Whoever's the most transparent and can reward the person taking the risk, I think that's who you see come out with a hybrid model that works.
No offense, John, but maybe additional or another model that is yet more payments for the brokerage firms, and maybe isn't the ideal way to go. As good as it has, as beneficial as it has been for firms like yours to allow you to do a lot of things like extend and reduce commissions and all the other benefits that come from it. I mean, that's kind of what the initial splash for this exchange is. Oh, they're going to be paying rebates to retail traders, and no one follows that to its logical conclusion, which is it actually goes to the brokerage firms, and then where it goes from there. In a lot of firms is sometimes dubious. So I think I agree with the spirit of this movement. I think there needs to be something that pays more attention to the unique needs of the retail segment of the market, whether or not, I suppose I'm just dubious that this is actually the exchange to do it. And Mr. C, why don't you want your big orders exposed to the Getco and Citadel buzzsaw? I can't imagine why you wouldn't want that. That's a fantastic thing for your liquidity.
Yeah, it's really not. Like, what's fantastic for liquidity is knowing that the guy on the other side is going to do what he said he was going to do. So we can report back to our clients saying, hey, that 10,000 lot butterfly is filled at 50 cents, just like we said it would be. If the cap commit guys should be the ones like getting antsy. If they commit to something and they go to put it into the buzzsaw and it gets chopped around, I mean, hey, we filled you at 90 cents, even though we said 50 cents. They're going to be the ones that end up eating all the risk. I see where the industry should go with the hybrid model, and it is an incorporation, maybe not an exchange floor. I think that might be a little bit drastic, but there's so much going on away from the floor in the exchanges that, I mean, you can't tell me that the regulators have a fair grasp on what's actually going on. It's all about speed and who can program the fastest, program that, I mean, the rumors that they're starting to, the predictive software is taking over. It's insanity. If anything, the centralization of an exchange floor isn't a bad idea, because then it's easier to regulate. Like, bring everybody in and sit them down and say, you can turn on whatever machine you want, but we have to be able to see it, and those machines have to run out of this centralized exchange location.
Well, you're going to love your trip down to the Options Industry Conference next month, then, because
everything
you just talked about,
eggs at me,
no, everything you just talked about are all popular topics of conversation down there, and they're quite heated and quite interesting, and banding about all those exact topics you just mentioned, and how the fact that the regulators don't have a clue about what's really going on out there in the space, and how this flow is being parsed up and has been getting parsed up for the better part of a decade, and how much of it is pretty much just taking place off the floor, and the floor, or the quote unquote electronic exchange, is just a place to stamp it. So there's a lot of that going on, which is all very interesting stuff. Really quickly, I guess we can touch on this article really quickly. I don't want to give it too much time, because my initial reaction to these types of articles, and there was a piece went up in Forbes today, listeners, called "Derivatives May Still Endanger the Financial Systems." When I first saw that headline, my hackles initially went up, but here we go, another anti-derivative screed. I really wasn't even going to read it. These things are like clockwork, it's all this typical stuff of beating on speculators and all the other nonsense. And I actually started to read this article, because we actually was linked up on our site, and I started to go through it, and it actually was a little bit more nuanced than your typical screed. It wasn't going on about speculators, it wasn't going on about any of that kind of stuff. It was just getting on about the notional value of some of the instruments that are being held by these large banks like Citigroup and Chase and Goldman Sachs and Bank of America, all the exact names that all those issues just a few years ago, and how that notional value is into the $250 trillion range, which is, many, many times the aggregate balance sheets or the equities of these individual names. And on the surface, you can say, okay, that's fine. But that still could be legitimate hedging components to that. And the person who actually wrote this came from an insurance company, so he actually looks at it from a hedging perspective, and he's a former chairman of the CFTC. So regardless of regulators and how little they understand, I would think this guy, at least from a hedging perspective, would understand that component of it. And he goes on to write at length in his article about how this $250 trillion in open interest, even when you net it out amongst the various exchanges, is still enormous and is still way beyond any even conceivable possible need as a hedging function, or as he writes here, a lubricant for the marketplace. And it's just really just banks swinging for the fences yet again, and so quickly after we had the last implosion. I'm not sure if you guys had a chance to read this one as well, but listeners, I think you should all take a chance to check it out. It's linked in our newsfeed on the optionsinsider.com, and unlike most anti-derivative screeds, they actually get in some interesting topics. He proposes a solution at the end, which is a little bit dubious, which is, of course, adding some additional sort of margin or side payment to every transaction to lessen the need for leveraging. And I'm not sure exactly what the proper solution to this is, but it is interesting to see that yet again, these too big to fail scenarios are already starting to unwind, or I shouldn't say unwind, but wind and right. Pop up in the marketplace again, well beyond, like he says, any sort of legitimate need to hedge downside in the S&P or in CDSs or whatever the case may be.
Yeah, and why wouldn't they? Like everybody's like, well, this will never happen again because Bernie Madoff, he paid the ultimate price and he's spending the rest of his life in prison. He was running a Ponzi scheme. Like, that was illegal. Like, show me all the people that are lined up going to prison that were trading non-transparent, illiquid derivatives. They're not. There might have been some fines handed out. Hey, I don't know a guy in the world that would look at a $25 million fine after he made $1.25 billion and say, oh, if I make $1.25 billion and I got to pay a $25 million fine, I guess I'll play that game. I mean, nothing's happened. Like, why wouldn't? Like, the government bailed everybody but Lehman out. Nobody's going to prison for trading non-listed, illiquid, non-transparent derivatives. And the government bailed us out. So, hey, that's a good sign for us in the illiquid, non-transparent derivatives market. We can lever up 10 times more than what we did in 07 and 08 and really get some positive returns, especially after we took all the Fed's money in the TARP program. Now we got
they know they have a backstop where they can't fail, right? It's a win-win outcome for them, and they know that they have government regulators that don't understand it whatsoever. So who's gonna monitor them? Who's gonna watch them?
Right, especially when the money that's getting the politicians elected is coming from the special interest groups. Like, hey, awesome, yeah, we're gonna get it. I wouldn't doubt that there's $250 trillion in exposure in the derivatives market. But I mean, so what? We collapse, the whole thing goes over again. Everybody loses interest. The people that still treat the stock market the way it should be treated, that use it as a way to hedge risk. To a pension fund, hedging risk. They're using the money they invest in the stock market to hedge their entitlement risks, and they're going to protect those risks using the derivatives in a non-speculative fashion. Those people will always be around. Think of the Hal Holbrook character in Wall Street. The quick buck artists are going to come and go with every bull market, and the steady players are going to make it through the bear. And if the general public, investing public, hasn't woken up and smelled the coffee yet, they will after the next one, maybe. But the stock market will be there, and the people that have a fundamental need and function to use the stock market for what it's there will weather every storm that comes at them. And until everybody thinks in that capacity, we're going to have these whacked out moves.
I don't understand why there isn't a central clearing apparatus for all over-the-counter transactions. And you just have to put up X margin. Yeah,
I thought the CME was going to create something for mortgage-backed securities or the OTC market that took down the whole country or the whole world in 08.
Apparently not.
The regulators probably said, "I don't worry about it."
That ain't going to work.
Well, that was the narrative coming out of 07, 08 was, central clearing is where it's at. That's why CME invested heavily in all the clearing, and Citadel and ICE were going to get into clearing, and clearing was where the future was and where the money was from a profit perspective. And yet and everyone thought the regulators are going to force all this onto the exchanges, and to a large part that really hasn't happened. And it's been interesting. That was the one consensus everyone had coming out of 08 and into 09 was, this is all going to move on the exchange, or at least the bulk of it.
The blueprint, like the OCC, works really well. You have a trade, you got to put some money up, and just a lot of guys want to push the edge of the envelope with capital. And if you're a guy trading 2 lots, that's one thing. But if you're a guy slinging, $1 trillion worth of of notional value, maybe you should have to be required to put up more margin. If it's when they increase, it's sort of akin to those guys with that $1 trillion notional value. I mean, probably realistically, all that stuff nets out to be very small. But just the fact that you have position size on, like now they charge more margin now for like a reversal conversion, even though there's not much risk there. But just the fact you've got it on, you have contracts on, you have a potential liquidity squeeze. They never charge those, or not charging those guys enough money for all that. And I think that's what the regulators don't get. It's not really the risk. What gets everybody is like the 1 month or 1 week or whatever it is, where it's just an insane liquidity squeeze, and all of a sudden everybody just runs out of money for a few seconds. It's not like they don't have it. It's just there ain't any around. And they never think really how to properly margin it, because I think most of the people that are sitting at the SEC, besides looking at the financial crisis kind of from the big picture, aren't in there actually managing risk, because they don't know how to do it. They've never ran a book, and they've never blown themselves up. I mean, what do we got?
Here we go. We should expect all of our regulators have to have blown themselves up at least once before they could regulate the market.
Well, I think everybody that's traded is probably, if you're still trading, you probably got close enough to the edge where you saw what it looks like, and you're like, I don't want to go there. And after that, you quote unquote, you do stuff. You try to avoid, as Mr. Kavanaugh, says, you use the products to manage risk in a useful manner. And let's be realistic. You got Dodd-Frank was written by the guy that helped create the financial crisis in the first place, and I'm quite sure he still has no idea what's going on. Look at the way the Senate even when they're talking to Lloyd Blankfein, like the guy sitting there, like, you're taking the other side of these guys' trades. And he's like, well, we are doing a market maker function. I mean, we have show them a bid, we show them an offer.
Define other side. Define trade. Define guy.
What is a trade? What is a transaction?
Define what the other side means. I think everything you're saying spot on. I mean, the OCC has done an absolutely fantastic job over the years of
the model.
The counter. Yeah, there's a new exchange out, that's trying to be friendly to the retail trade of the NASDAQ. The NASDAQ is mentioned the same kind of thing. You got to have the money, put up the money for the spread that you want to buy, or don't buy it. That's it. That's all that can happen.
And I think they do, but they're not going to. But I think the problem is, these banks don't want to be. They're still not at the point where they're going to give in to that. Eventually, they clouded Dodd-Frank up with a lot of just hateful anti-capitalist stupidity instead of just put up more margin, guys. I mean, it's really that simple.
It is. It's a sheet of paper that says, show us everything in your firm that's a derivative that's used to hedge risk. Show us every derivative in the firm that's used in a speculative manner, and show us how much the firm makes with that money.
Right. And you have to show and the counterparty has to have the opposite position. If they don't match, like in the old days, it's a break.
And you put up more capital.
And you put up more capital.
But then we won't be able to make as much money on the fees. I mean, that's what the argument. They don't care what happens, because there's no downside. There's no risk.
Well, they let Lehman blow up. They will let another one blow up. They'll always. It sounds like what they'll do. They'll let one blow up, and you just don't want it to be yours.
Yeah, they did it. They did it with Lehman. They did it with Anderson back in the day. They had the one firm that's a scapegoat for all the ills of the industry.
One is going to go if it blows up.
Then the guys that work there, they just call the guys that they know at the ones that didn't blow up, and they end up getting their job. They take all their clients. They say, "Hey, we're really sorry. Everybody was doing it. We were just the unlucky ones." And the clients say, "You know what? You're right. I feel so bad for this guy. He's going to lose his house if he doesn't get this job. So I'll go with him." And then it just transfers to another firm. Dick Fuld, last I checked, is not in prison. Like the largest bankruptcy in the history of the U.S. That I don't know how that's not a prisonable offense. I guess it's not, but whatever. What's Dick Fuld doing nowadays?
I mean, realistically, they just lost money. That's what it was. He lost a bunch of his own money. He's obviously not poor, and a bunch of other people lost a lot of money because they just don't understand Short-Gam, I guess.
This is why I love to bring these things up when Federal Holiday Mike is on the show, because I can just wind him up and let him go.
Don't get me started.
I love it.
Don't even get me started.
It's fantastic. But I could go on about this for quite a while, but we do have a few other segments to get to.
We're out of time.
So we're going to close out this trading/soapbox block and move right on to the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and welcome to an abbreviated Odd Block where we discuss what was lighting up the old tape today, and there were a lot of bullish call spreads on the tape today. That seemed to be the trade du jour. We're going to kick things off with Gap, ticker symbol GPS, because when you think GPS, of course, you think clothing retail. Fantastic ticker symbol there. They've been averaging about 9,000 contracts a day. Of late, they did over 33,000 today. A good chunk of that was in a sizable bullish call spread. This came on the heels of an upgrade, and you know how much we love analysts here. Someone came along and upgraded Gap to above average with a price target of $32. This is after they closed at $26.44 today, up about 30 cents. This is a name that's been rallying pretty hard, up about nearly 50% since the beginning of the year, and looks like someone's betting that this rally is going to continue here in good old GPS. They picked up 6,500 of the May 2830 call spreads and netted out to about 41 cents per contract. So this was a relatively sizable upside bet here in the May expiration month that GPS is going north before it goes south again. This has to rally about 10% for this trade to start to pay off. And Gap has earnings on May 17th, so this is also an earnings play. So, and then keeping in the bullish call spread theme, we're going to move on to Electronic Arts, ticker symbol EA. This is another one where the bulls are out in force looking to spec to the upside with some bullish call spreads. EA closed today $16.71, up about 22 cents. This is the name that's been doing about 15,000 contracts a day, and today was actually a light day, only 8,000 contracts, and a good chunk of that, 5,000, was in this one upside spread, or actually at the money / upside call spread. It was a 2,500 lot of the May 16-19 call spread that a trader came in and scooped up for about $1.98 here in good old Electronic Arts. Also, if you start parsing the open interest numbers on that 16 and 19 strike, you see that an 800 lot of this spread went up last Thursday as well for about 98 cents as well. So this could be the same guy adding to his spread, doing a net of 3,300. Could be two different trades from two different traders, and someone saw the first one, thought that was a good spread. I'm going to do the exact same thing. Regardless, these are both positions where they're specking to the upside here that EA is going to rally into May expiration. I don't have the earnings date here. Actually, they're looking like they're saying the 2nd here for Electronic Arts. So this also a potential earnings play going on in Electronic Arts. Andrew, I know you've been watching a lot of the gaming companies. Electronic Arts ever come up on your radar lately?
Not lately. It's a name I used to trade. It just got kind of dowdy.
Yeah,
these
it had
trades
some.
don't look too bad. I know that's another technical term. Dowdy.
It had some quiet years there, I guess you can say. Good old EA.
It did, yeah. When then Ivy gets down to 38, it's a $16 technology company. It's like, big deal. But this doesn't look like too bad of a. These long call spreads are a nice way to trade. Although there's that one pension fund guy that didn't like call spreads. It's like, I don't like those. They never work out how you want.
He didn't say call spread. He just said spreads.
Oh,
you never get paid as much as you think by the time you unwind them.
He paid $1.98 for a $2 spread. He's all fucking out. He can't make any money.
Yet he's amassed hundreds of millions or billions under management. So there you go. We're doing something wrong here, liking spreads.
Yes. We're doing. But no, I like keeping an eye on these things. But they don't have that kind of explosive growth they did, in the early 2000s. I don't know if it's because Zynga's ruined the whole gaming thing or whatever, but with Electronic Arts and Take-Two, and they're it's kind of like a little cabal of names, but they actually are kind of nice little traders, to be honest. But I don't see anything special about wanting to go into this earnings here, except for I'd say it's a fairly balanced, relatively cheap play on the earnings.
Yes, sir. And last but not least here in this abbreviated odd block, TJX. They run TJ Maxx and a bunch of other discount retailers. They had some, looks like mixed volume across the board. One guy came in and spec'd pretty hard to the upside, picking up about 3,000 of the May 42 half calls, which are near-term upside. TJX closed about nearly $40 today, up about 16 cents. So these are a wee bit out of the money calls. Picked them up for about 33 cents. He's looking to spec on good earnings coming out in May 15th for TJX. At the same time, someone also specking to the downside that about 3,000, roughly the same size trade going up in the July 37 half puts. They don't appear to be related trades. This wasn't a spread. And about 3,000 of those going up on the July 37 half puts. The bulk of those were purchases around $1.05. So some mixed activity going up in several large chunks here in TJX. Some saying bright days ahead for the old retailer. Some saying dark days ahead. But for us, ahead, we need to close out this abbreviated odd block and roll right into the Express Block.
The Express Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and welcome to the Express Block. This is, of course, the portion of the show where our resident Canadian expert, none other than John Griegus, takes the reins. Mr. Griegus, aside from Loonies and Molson, what is catching your eye? What has been going on in the land of OX you'd like to let our listeners know about?
Just a couple articles that the customers were calling in about, and the brokers on the desk were talking about. I don't know if you saw Friday after the close, Groupon came out and had to restate some figures from the past quarter.
Gee, what a surprise! They've never done that before.
It wasn't a good thing. But I don't know if you saw the action on Groupon today. We did get a lot of phone calls. It was down. I think it closed down over about $3, which actually is worse than where it started the day. I think it was only down about $2.20 to open, and then sold off there at the end of the day. But they reported material weakness, in quotes, which pretty much says that we've said this before in the show, that they've been growing too quickly and not getting their accounting quite in line with what the auditors kind of have expected. So we saw a lot of people buying downside puts and bear put spreads and a few call spreads. Bear call spreads and bear put spreads go off this morning, and it looks like it kind of worked out for him because it did close near its lows of the day. I've been selling puts on that thing every time it sells off. I think this time I may wait about a week because it does look like there's a support in the low 14. So I'd like to see if it tests that first and then maybe put something on. But yeah, I know we've set it up here on the show. Mark Longo believes it's a Ponzi scam, and unfortunately, it's looking like that more and more as they open up their books to everybody else.
How many companies have to restate their earnings twice now? They've done this in the past year. You think after the first time they would get their act together where they were double booking the revenue based on, they were including, I believe, their portion and also the retailer's portion in their net revenue. So they had to, of course, change that. And now I don't know the specifics of what they were doing here, but two restatements within the calendar year or so, that's just, that's crazy.
Yeah, not good. I think they attributed some of it to higher refunds to merchants. So, and I know Groupon had kind
That's
of made
always a good sign.
They can pretty much pull from a hat what they want to state it is. But I know they had moved into some of the bigger ticket items. You probably get spammed on these Groupon, travel deals and other bigger items, and not your $20 and $30 Groupon. So I'm thinking that those have a little higher rate of returns than your normal Groupon. Another one, and this is probably going to get Kavanaugh refired up. So sit back down and this will be the extended show. But there was another article that came out this morning, and this just has me. This is just crazy with the way that MF Global handled their business in the last few days before they were going bankrupt. But I don't know if anyone else caught this article. It was for customers that saw the company going into a tailspin and started requesting their money out the days and the weeks leading up to the bankruptcy. So I guess normal operating procedure, or what the requests were by these customers, were to get wire transfers. And at Options Express, our wires go out in the morning, and they're at the customer's bank within 2 to 3 hours. Well, these people were requesting wires, and they haven't documented that they were requested as a wire, and then they would send out a check, obviously because it's going to take 3 to 5 business days for that check to get there. And in the meantime, MF Global is holding on to the money. So you had all these clients that were doing the right thing, trying to get their money out. We had talked earlier in the show about like criminal charges and people, knowingly doing wrongdoing. This is just horrible that you would have people pretty much. It doesn't say you're stealing their money if you're holding it up, and so because you need to use it, and if you don't have that money, you may go bankrupt. Just criminal what they had done here. So I know a lot of the Schwab people used Lynn Waldlect, which MF Global ran or owned. So unfortunately, I hope none of them got caught up in this debacle as well. But just bad business practice when you're sending out a check so you can hold up someone's money and keep your hands on it.
Yeah, you're gaming the float because you're going to be bankrupt by the time that check arrives anyway, so you never have to pay that money.
The key word you said there, John, is business practice. That is so remotely far from anything in the business world. Like I was just typing that they might as well have been writing IOUs on Post-it notes and purple crayons at that point. Like, what's the point? It's unbelievable.
It's terrible. Yes, but will anybody go to jail? Will we see? I know that what was her name? Elliot O'Brien or Edith O'Brien was. I think she was the treasurer, and she was up before Congress last week, and she just sat up there with her grin, and it didn't really respond to any of the questions, and it's just kind of like, okay, we've seen that before. We've seen the big. The big desk of Congress behind, the microphone, and we've seen the lawyer speak into the ear, and then nothing ever seems to get done. I still don't know what happened to the Refco guy that, stole $980 million to start his own hedge fund, and that went bankrupt.
They gave him an island in the Caribbean.
It just seems like, at a point enough gets enough, but it just seems that short-term memory and a lot of cash make things kind of get swept under the rug.
I think Corzine's a big enough target, though, that they'll want to keep going after that. If you're a politician and you want a good populist issue to rally around, going after the manipulating head of a derivatives trading firm who also has a political background that you may want to go after and has ties to Goldman, it doesn't get much juicier than that. Who's going to rally around Corzine? So these guys
that is a big fat target.
Exactly. These guys can beat up on him all day without any sort of repercussions. So they're going to do that. They're going to keep dragging him out. And if the CME,
they're going to give him a show on CNN. Co-host with Spitzer. Watch out.
And if the CME has their druthers, they're going to keep him in the spotlight as long as they possibly can. So I think there's a lot of people have a vested interest in keeping the crosshairs on somebody. I think the treasurer, she obviously didn't do herself any favors, but I think at the end of the day, they're going to go after Corzine in some way, shape, or form. He was the man in charge. He was the man who ostensibly authorized this. He's the guy that Duffy threw under the bus in front of Congress and said he knew about it. So I think there's a lot more to be unwind here and to play out before it's all said and done.
Well, I hope so. We need a couple of sentences is to get the confidence back in the market.
I will say, not to extend this extended edition even further, but one of the most depressing panels when I was down at the FIA Boca conference a couple of weeks ago was the MF Global panel, because I sat in on it hoping that there would be some sort of insight into what the hell actually happened. And the panel was littered with regulators and auditors and SEC lawyers and within five, and the CEO of RJ O'Brien. And I felt bad for him, because he kept trying to pull the conversation back to, wait a minute, there should be a fundamental question here. What happened to the money, and what are we going to do to prevent this from ever happening again? And yet the lawyers kept taking it in this other direction of, well, Section 503C of this rule means you can't touch this segregated money versus this one. And the panel got so bogged down in such a horrible, excruciating minutia that it quickly became obvious what the actual problem was, and that's what it was. It's that ridiculous minutia makes any sort of resolution in this kind of problem almost impossible, because clear-headed, rational people can't cut through all that in time. And that at the end of the day, that was kind of the summarization of that panel, was that there's obviously a problem there, and that there's too many lawyers at the helm writing these regulations that make no sense and don't work with each other, and yet there's numerous issues to be cut through. I think to the point where the CEO of RJ O'Brien was relatively flustered on that panel, because it was clear that that was the core of the issue and no one was willing to get to it. So I didn't mean to extend your already extended Xpress Block there, John. Anything else going on you want to let us know about?
No, I mean, I'll try to keep it short because I know we are running long, but shortened holiday week. Remember, equities are closed on Friday, early close for futures. So that's about it.
Yes, let's get into that then in the old Around the Block segment.
Around the Block.
All right, and those car horns mean it's time for the final segment of the show, Around the Block. This is, of course, a portion of the show where we dive into the murky ether of the future and tell people what we're looking at and what we're paying attention to for the next few trading sessions going into the end of the week. And as John alluded to in the last session, it is a shortened trading week, a long holiday weekend. So if you're an options trader, that should be first and foremost on your mind. We all have to know when the weekend is coming out and price it accordingly. And Andrew, what are you watching here on your screens up there in the land of Maine and lobster?
I really want to see some little confirmation with some volatility come in a little bit more. I am closetly bullish, but am hedging by doing stuff and looking for more backspready type things to do with these ultra low volatilities. So that's that's kind of where I am on the whole thing. I think we could go higher, but man, all it takes is a hiccup and we're down 2%. So. And
Federal Holiday Mike, aka Monday Mike, what are you watching over there aside from the various minutia of regulators and exchanges?
Our eyes are constantly fixed on the market. We're always taking on new clients. We're willing to do a portfolio review, a comprehensive portfolio review to see if there's any way that we can integrate any kind of hedged risk sort of strategies using the use of options. So if you go to our website, knowyouroptionsinc.com, click on the stopwatch. One of the advisors here would be more than happy to chat with you. We've got some webinars coming up in the month of April and month of May that we're going to take a top-down approach and kind of take what everybody knows in the marketplace, how they've been invested, and kind of walk them backwards into why they're invested that way, and then try to make what they're doing a little bit better. So keep your eyes and ears open for those webinars coming out in April and May. And that's about it right now.
And so just to refresh our listeners' memory then, if they click on that stopwatch on your website, you will then promptly lever them up to 250x their notional value through the leverage value of derivatives, correct?
Exactly. Yeah, we'll actually walk them the other way and show them that options is actually not a four-letter word, and it shouldn't be screamed when they hear options. But our the clients that work with us get it. They're the clients that have money, that have made money. It's hard to make a buck out there, and rather than stuffing the money under the mattress, we're giving them a hedged equity component using the option. So it's a hedge. It's not a speculative tool. And we show them how to take their portfolios that 9 out of 10 times the portfolios are diversified well. It's modern portfolio theory. It's just people feel so burnt from what's happened in the last 12 years, ups and downs, that they're starting to question if they've been questioning whether modern portfolio theory is enough. And we just take what they already know and make it a little better.
Well, if you're one of those ones out there questioning modern portfolio theory, and there are many of you, CAPM, standard diversification, Sharpe ratio, all these things being crushed in much modern academic research, I should say. And if you're interested in that, by all means, check out our volatility views show, and particularly the one we just recorded this morning where we get into that topic. I believe that's episode 47 will be coming out tomorrow morning, where we get into that topic at length about how you really can't achieve diversification anymore just by using underlyings and equities. And the old buy 12 equities in your diversified approach really doesn't cut it anymore in a world where assets are 80% correlated across the board. So interesting stuff, and by all means, check out Volatility Views if you want to know more on that subject. And last but certainly not least, Mr. Grigas, what are you watching aside from a shortened trading week here for our listeners?
Well, unfortunately, it's not a holiday for Schwab, even though the exchanges are closed for options. So I will be in the office. We'll be supporting those futures. Sometimes around tax season, you get a lot of people that do have that day off that will be calling up, so we may have our brokers, diversifying their skills and answering some customer service calls. Strangely enough, though, they do have non-farm payroll on this Friday, even though the markets are going to be closed, which you really don't see that too often. I was kind of surprised by that. So we watch the non-farm payroll and be watching the clock on Friday.
Gotta love the new corporate overlords making you work on the days off, sir. There you go.
Yeah.
Thank you for that, Mr. Grigas, and thank you for that, all of my cohorts, my partners in crime, for joining me on the old show today. That is going to do it for this episode of the Options Block, but before we go, by all means, let us know what is going on that may interest and or intrigue our listeners, starting off with you, Mr. Andrew, a.k.a. the Lobster of Options Pit fame. What is coming up in the land of Option Pit that may interest and or intrigue our listeners?
Coming up at Option Pit. So 2 things. Again, we have a big thing we're going to be announcing in June, all-day seminars from the Option Pit in Chicago, where we will be Cubs and kind of a whole get-to-know Mark and Andrew, whole day of, the Cubs, food, and learning about trading options. And also, we are going to be reposting a very popular webinar we did on trading around the earnings cycle and what options do, kind of prior to earnings and post, helping guys figure that out so they don't get taken to the volatility woodshed. So that will hopefully be posted on our site tomorrow, and it will be called Trading Stock Options Around Earnings.
All right. Thank you for that, Andrew. And second, I should say, and even though he did just mention it, we'll reiterate it here, Mr. Federal Holiday Mike, I'm assuming you have some interesting webinars coming up for our listeners that you want to hit on.
Oh, yeah. Coming up April, May. If you go to our website, you can sign up for our newsletter. We send it out weekly, and the webinar schedule will be listed on our weekly email on the update. So stop by the website. We've got a lot of people here that believe that the rewards sought in the marketplace should go to the risk taker, the people that are actually investing the money, and us as advisors, we'll make our money by giving you the information you need to make informed decisions, and you reap the rewards.
All right. Well said,
That's
sir.
That's it. I'm off the soapbox, sir.
Well said, sir. And last but not least, we have 30 seconds. Mr. Grigas, what is coming up in the land of OX that may interest or intrigue our listeners?
As always, our free webinars through the month of April. Check them out. If you don't have an account, they are free. So create an account, come in, virtual trade, check out our webinars. We got monthly futures outlook with Jim Wyckoff coming up tomorrow. If you're a big futures guy, you definitely want to check out that free webinar. And then through the end of the month, we have Intro to Options Part V, which I guess is going to revolve around short puts. So get in, get an account, sign up for a webinar.
Thank you for that, Mr. Grigas. Now, by all means, go make your train, sir. All right. That's going to do it for this episode of the Option Block. We, of course, want to thank all of you out there for downloading and streaming and subscribing to this program and making it such a success. We'll see you later on this week right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.